Hi, all. This is Brian. I am going to be going over chapters 5 and 6 of taxschool.com. This is kind of a brief overview of the material. It does not go into the full detail that you would go through actually going through the modules themselves. I do want to point out that this information is not relevant to 2021 tax year. The information provided in here, especially the credit amounts and some of the requirements for obtaining the credits, have been substantially overhauled due to the uh, COVID pandemic that has caused so much disruption in everybody's life. Okay, so I'm going to go through these fairly quickly. There's one section that we should point out that I'm not going to be able to go into full detail, and I'm going to kind of skip over some of the slides, but they might be useful for you to go through. But I'm kind of going to give you just a brief synopsis of the give you the point of it all. Okay, so by the end of this, you should be able to kind of understand for the most part the savers credit, child tax credit, and then we'll move on to section 6. I'm going to show you how, I'm going to give you this basically a summary, and then I'm going to show you how to find the information you need to complete the assessment in order to move forward in tax school. Okay, so we're going to, by the end of this chapter, the objective is to learn about retirement savings contribution credit, the child tax credit, credit for other dependents, additional child tax credit. There's also due diligence, which is a pretty important portion that I'm not going to be able to spend a lot of time on just because of the time restraints. But I'll give you the basically the point, and then we'll. It's something we talk about often, so it's not going to be totally lost on you. But we'll get into that as we get there. And then it's also going to describe the requirements for the child tax credit and the credits that I've already discussed. Okay, so the savers credit, this will be quick. Savers credit is a non-refundable credit, which means that if you don't have a tax liability, you cannot take full full advantage of the credit. Okay, so tax liability, if you don't have taxable income, if you have taxable income less than the standard deduction amount, you're not going to have any tax liability because you have no taxable income. Therefore, since the savers credit is non-refundable, it can't be issued as a refund. It can only go towards tax liability. You won't have any benefit from that. Okay. The credits received for making eligible contributions to an employer-sponsored retirement plan or to an IRA. Okay, so that could be a Roth IRA or a traditional IRA. It doesn't. Either one will work. Okay. Excuse me. You do use 88 form 88. You use form 8880 to calculate these, but that's all done in our software for us, so we don't really need to worry about that aspect of it. Right? These are the things that will disqualify someone from the savers credit. If their AGI, their adjusted gross income, is too high, falling in these three categories, if they're higher than those based on these filing statuses, or if any of the following is true. They were not 18 before the end of the tax year, they were another person's dependent, or they were a full time student during the tax year. All right, so this one is talking about Julie. She contributed to an IRA during the tax year. What would disqualify her from claiming the savings credit? She's a full time student. She turned 19, so that wouldn't be. No one else claims her as a dependent, and her filing status is married filing jointly, and her modified adjusted gross income is 48,000. The thing that would disqualify her is the full time student status, that she would not be able to claim the savers credit there. Okay, and this jumps into the child tax credit. Now, here's one of the instances where the information is not accurate. The $2,000 amount is not accurate for this upcoming tax year. It's always been $2,000, and not always, but it's been $2,000 for the past several years. So for the purposes of doing the assessment for this module, you are going to want to keep in mind the $2,000 number. Okay. The child tax credit is also a non-refundable credit. So if there's no tax liability, there's no benefit. However, it does roll over into something called the additional child tax credit that is refundable. It makes a portion, $1,400 maximum, of the child tax credit can be refunded to the taxpayer. All right, in order to qualify, the taxpayer must have a social security number or an ITIN, income tax identification number, by the end or by the due date of the return. They cannot claim the credit if they get a social security number or an ITIN after the due date. So typically April 15th, but who knows? We don't know when the tax year is going to be in this COVID world of ours. So for a qualifying child, they must meet all of the following requirements. They must have a social security number. They must be under the age of 17 on December 31st of the tax year. They can't provide more than half their income. They must be claimed as a dependent on the return. They must live with the taxpayer for more than half a year, except for certain circumstances that we'll discuss later. They must be a U.S. citizen, resident, or national. They cannot qualify, or they cannot claim their, excuse me, they cannot file a joint return, so they can't be married. And uh, they have to be related to the taxpayer. Okay, so this goes over an example talking about a release form called an 8832 that allows the custodial parent to claim a child, allows the custodial parent to release the claim of the child to a non-custodial parent. That comes up very seldomly, and if that you ever come into that circumstance, definitely get a hold of a veteran tax preparer or a member of management to help you with those um, circumstances. All right, so this one talks about is another example where it talks about the child not being a citizen and lived in the U.S., so they can't claim the child tax credit. The ODC is other dependent credit, and it's a small credit that can work for people that are not a depend or not a don't have the proper relationship to the taxpayer. So it could be someone that's not related. There is a $500 credit, non-refundable credit for other dependents. They fall into that category. This goes over some of the um, requirements for the other dependent credit. They're very similar to the others. Additional child tax credit. This is something that is utilized when the taxpayer does not have a full tax liability to utilize the full $2,000 of the child tax credit, and it comes into play when that happens, and they can get as much as $1,400 per qualifying child, um, and that's the numbers we're gonna want to focus on for this assessment. However, they're not accurate for this coming tax year. Okay. This also says that the earned income must be greater than $2,500, which is no longer the case, but for this assessment, it is. Okay, so this is the due diligence section. This is the section I'm saying that I can't really go into as detailed as maybe I should, but read over this section, make sure you understand everything. The key takeaways here are that we must ask questions of the taxpayer to determine their status, their filing status, and that they qualify for these five credits in particular. Okay, child tax credit, other dependent credit, additional child tax credit, earned income credit, and the American Opportunity Credit, which is a college-related credit. Okay, higher education-related credit. So we have to ask questions to make sure the information is complete, it's accurate, and it's consistent. Okay, so they talk about the three I's, which are the incomplete, inaccurate, or inconsistent. We're fighting against those things, and basically we need to ask questions regarding the situations of the taxpayers, like where's the other parent if it's not a couple claiming a child. Um, Ask questions about who else might be able to claim the child. It doesn't come into play when there's a married couple claiming their biological child. This is more if it's a single person claiming their biological child. You need to ask about the other parents. Why aren't they claiming them? Ask about their living situation, who lived in the home. You got to make sure that the child lived in the home. You do need to ask if there are if the taxpayer, if needed, can provide records to the IRS, like school records showing that the child lived with the taxpayer during the tax year, doctor's records showing the same, birth certificates, that kind of thing. So those are all things that we ask, and then we take notes of those things in Profiler to make sure that all that information is in there and to verify that we asked it. Okay, so these go into this starts the due diligence checklist, which is Form 8867. It is automatically populated by our software profiler in order to make sure that we're in compliance with everything. So I'm not going to read each one of these things, but do take the time. You may want to pause here and read through these sections to make sure you have a good understanding. But this is basically talking about filling out the 8867 form and e-filing the form. This one is an example of the what takes place during filing, where it specifically talks about the split between two tax preparers, that they both must complete the 8867, but that's all taken care of for us in Profiler. It talks about the information that's actually on the form, and then this goes into the parts of the form. Okay, and then it goes into what the each line by line means. Okay, and this is important stuff, not necessarily to get through tax school, but for you to understand what you're filling out, because this is something that you're filling out, and Profiler's filling it out for you, and then you're signing it saying that yes, I completed these things, and yes, I can attest to this information. Okay, and it's basically saying that you're ensuring that you understand the requirements of the credits, and that you're not ignoring any information that may have come to light even accidentally through your conversation with the taxpayer. Okay, and it's saying it wants to make sure that you ask all the questions you need to ask and document those questions and and the taxpayer's response to them. Excuse me. All right, so the taxpayers must clearly understand the questions that you're asking them, and then you must document the question and the responses. Okay, and this is used to determine whether they qualify for certain credits and the relationship that is between the taxpayer and the dependent. Okay, so this actually gives some examples of the questions that should be asked. So this is pertaining to a stepchild. Then from there, it's talking about a boyfriend and a girlfriend's child. Generally speaking, a boyfriend and a girlfriend cannot claim a child as their own dependent. That would be an other dependent situation. Um, they People try to do it all the time, and it's important to say or to keep in mind certain aspects, like if the taxpayer is talking about, like, well, her mom, such and such, or her dad, such and such, then you say, okay, so make sure to ask if they're the biological parent. Okay, that's very important. Are you the biological parent of this child? If they say yes, then that is what it is. If they say no, say, okay, so who are the biological parents? And then dig into it deeper there, because they shouldn't be claiming a child as a child if they're not the child. If that makes sense. Okay, so then you cannot know that the information is incomplete, inconsistent, or incorrect, and you must make reasonable inquiries to resolve any questions regarding those three things. So if there's anything that just seems off, definitely ask the questions, because um, we can't let these things go through with kind of a wink wink, type of situation. It doesn't work out well for anybody in those um, circumstances. So this goes over some of the reasonable inquiry things. Has to do with talking about this one's talking about non-custodial parents, asking if they're biological parents. Then this one talks about looking at the difference between a taxpayer's age and a dependent's age. If there's not a very much a big of an age difference between the two, then you ask questions about are these children yours? If there's only an 11-year difference between the taxpayer and the child, that kind of raises some red flags. Sometimes things don't surface immediately, right? Like with a taxpayer comes in and they've been a client for a year or two, but if and there are some reasons why inconsistencies show up. People switch children back and forth with the other biological parent from year to year, depending on a divorce decree or just a verbal arrangement. But you need to be aware of read your notes, read the notes that are in there for the previous year, where it talks about who the children that are being claimed, about the biological parent in those situations, and then just uh, be aware of those things while you're doing the return to keep an eye out for any inconsistencies. Okay, so this just talk kind of goes into that a little bit deeper and talking about line 4. Next one talks about line 5 and keeping the records. All this stuff is taken care of by Profiler for us. We don't really need to worry about that. So this continues on a previous example where it discusses due diligence and copying court records, that kind of thing. So we need to keep records of anything that we have that might be pertinent. This goes into asking about school records. I forgot to mention the landlord or property management statement. So if the kids are on a lease, um, that could help in proving the fact that they did live with the taxpayer. But those only come into play when the IRS reaches out requesting information to prove that a child lived with a taxpayer. But we ask these things to make sure that they would have them in case the IRS does request additional information from them. Those documents are not required to be disclosed to the tax preparer at the time. They just need to make sure that the taxpayer has them and understands that they may be requested by the IRS at some point in the future. Okay, then there's a section in Profile that asks you if the taxpayer has ever been denied credits in the past, and it's simple yes or no. Most people it's no. Some people are denied credits because of various reasons, but if they have been denied credits in the past, they need to complete Form 8862 to kind of reinstate their ability to claim certain credits. And then line 8 discusses if a taxpayer's reported income is only self-employment, that we do our job to document the self-employment income expenses, all that kind of thing. These lines do things that the profiler automatically kind of comes to a conclusion on its own, whether the taxpayer and the dependents qualify for these credits, and then fills them out accordingly. Now, okay, so this one talks about their penalties that are used as kind of a scare tactic to make sure that preparers are asking correct questions. Um, this all comes down to intent. So we can't be negligent, but there's a very small likelihood that anything's going to happen with these penalties. I wouldn't really worry about it. Kathy, as an employer, is committed to hiring an attorney for anyone who has these types of issues. As long as they're following all the rules, she will definitely go through the motions to help fight these types of situations. This next one is an illustration. I'm probably going to skip over several of these things because they're kind of just harping on these same issues that we've kind of already talked about. But I'm going to go through each slide so you can pause on them long enough to, read through and take a look at what is actually taking place here. Okay. And then we've got a knowledge check that I'm actually going to skip over as well, but I want them to be in the slides so you guys can take a look and answer the questions for yourselves. Okay, this one talks about claiming the credits after a disallowance, the 8862 that I talked about earlier. You're really rarely going to come into contact or do a tax preparation for someone who had this, but the it talks about the requirements of whether you need to have the 8862 or not. It depends on a couple of different factors, but I don't think it's really all that relevant here. It's just it happens so rarely that we don't really need to um, worry about it too much here. Okay, so we're going to do an example of that. This person's being denied, and continue with the example here. So this goes to the summary. This talks about basically everything we've gone over so far. So if you feel the need, I would go ahead and pause on these to read through them in detail if you would like. I am going to go ahead and jump through and go to the next. Okay, as I've done before, I'm going to show you guys a quick trick to getting through the sections. So we're in session 5 here. You can jump, once you log in, you can jump down to the assessment section and click next and begin the assessment. Okay. From here, I would definitely use the resources tab here and the participants manual to go ahead and have the information at your fingertips. Okay. So I'm just going to do a couple of these. Julie contributed to her employer's 401k plan during the tax year. What would disqualify her from claiming the Savers credit? She took one class at university. That's not going to disqualify her because she's not a full-time student. She turned 19. So she was already, during the tax year, so she was already 18, so that's not going to disqualify her. No one else can claim her dependents, so that doesn't disqualify her. But if she's filing status of married filing jointly with a modified AGI of $65,800, that is going to disqualify her. Okay. So this is loaded. This is the participant's manual. So you can find things like that here. Okay. So that's what I used to use to answer that last question. Let's go ahead and do this one. Claire contributed to a qualified employer-sponsored 401k, traditional IRA, or employer-sponsored cafeteria plan, Roth IRA. Which contribution does not qualify? So the cafeteria plan, I don't really even know. I can't remember what they stand for, but they're not sanctioned retirement plan. Okay, so that would be a disqualifier of the Savers credit. Which taxpayer is eligible for the Savings credit? Qualified widower with HEF 38,750, single with 32,000, married filing jointly with 66,500, and a household filer with AGI of 48,900. So who is eligible for it? So I would jump over here, and it looks like we got 32,000 for somebody that's single. So it disqualifies them if they're at 32,500. So this person right here, they are eligible for the Savers credit. Okay, I'm not going to go through all these. I want you guys to search through and find the information yourselves, but I am going to jump to the next section here momentarily. Okay, we are at the earned income credit. Okay, and earned income credit is a credit for taxpayers to basically incentivize them going out and earning income. Okay, so it looks like a bell curve where the credit. Okay, so if this were the income line and this were the credit dollar amount, as the income increases, the credit amount increases. Okay, so it goes up for a while, and then it stops at a peak, and then it starts going back down. Okay, so people will sometimes ask why, their earned income credit is so low. Well, it's because let's say they made $10,000 more this year than they did last year. You might actually phase out of the earned income credit. Um, but that's kind of generally how it works, and the purpose of it is to incentivize people to make go out and make money. Okay, so objectives are to determine whether people qualify for this. The due diligence is pretty much the same, and then it talks about reporting the earned income credit and um, are able, the requirements for a taxpayer to claim the earned income credit after they've been disallowed. All right, so here are the general rules. This is where you're going to find basically all the information you need. This is not updated for the following tax year, but for purposes of completing the assessment, this is the information you're going to want to have handy, okay? But that'll be in the resources, just like the other resources that I have shown you just a couple minutes ago, okay? So these are the rules that must be adhered to. Okay, there's an AGI limit. It must have a valid Social Security number. Filing status cannot be married filing separately. So married filing separately will disqualify someone from claiming the earned income credit. They must be a U.S. citizen or resident alien. They cannot file a 2555, which is a foreign earned income um, form on the tax return. They must have less than a certain amount of investment earned income, and they must have earned income. So, so I guess this is going just back to the rules again. Okay, and then this is talking about having a valid Social Security number. So, as long as they have a Social Security number, they can claim by the due date. They can claim the earned income credit. They must not have a Social Security number or a Social Security card that has not valid for employment. That disqualifies them from this. So there are different requirements for or different dollar amounts and income limits based on the number of children that are claimed on the return. And this talks about that the child must have also have the Social Security number in order to for the taxpayer to claim the earned income credit. This discusses the not being married filing separately because that's kind of a loophole. Like, say one uh, member of the married, one member of the couple makes $80,000, the other one makes $10,000, and they do married filing separately. Well, then the one that makes $10,000 can't get earned income credit because it just doesn't make sense. Okay, so this one goes through a case study. I'm not gonna spend much time on this, but it just talks about, goes through a scenario and talks about whether someone can claim their earned income credit or not. But it all falls back to that um, slide that shows the rules. Okay, so a non-resident alien may not claim, or sorry, a non-resident alien may claim the earned income credit if both of the following are true: they're married to U.S. citizen or a resident alien and file married filing jointly, and they choose to be treated as a U.S. resident, which is a distinction that they can use to qualify for the earned income tax. Okay, so this is they can't file a 2555, which is foreign earned income, which goes back to just closing any loopholes. Okay, can't have somebody that's making so much money overseas also qualify for the earned income credit. And then this is going to jump to the investment earned income credit. So there's thresholds on the amount of investment income that can be um, obtained by the taxpayer before disqualifying them for the earned income credit. This one also talks about some kind of loopholes, but it's actually not all that important. But I mean, all of this just makes sure that the people that are claiming earned income credit are doing so lawfully. So read through this. I'm not trying to put, say it's not important, but it's just, the circumstances in which it happens are a fraction. This talks about military personnel when it comes to earned income credit. They can elect whether their non-taxable combat pay is considered earned income or not, and it's just a special election they get for being a combat military personnel. And this one goes over a knowledge check. I'm not going to spend time on these, but I'll give you enough time to look at them, pause, and then give yourself the assessment. Okay, rules for filing with a qualifying child. There are a qualifying child test. Must not be a qualifying child for more than once. Um, the taxpayer cannot be a qualifying child. So this gives you the breakdown: relationship, age, joint return, residency tests. Those are all things that must be passed in order to um, use a qualifying child for the earned income credit. Here's a case study where it goes through a scenario and talks about whether or not something applies. All right, qualifying child can be used more than once. Only one individual can treat the child as a qualifying child. I think that pretty much goes without saying. But it just discusses that in a little bit more detail here. There are some exceptions, and those pertain to special rules for divorced or separated parents. And this is where not two parents can't on separate returns use the single child for the same credit, but they can split them up, and one uses them for earned income credit, and the other one uses them for child tax credit. That can be allowed, but you're not going to run into it very often. And then it also talks about tiebreaker rules that when a divorced couple or a non-married couple both try to claim the um, the child, that they use tiebreaker rules to determine who is actually eligible to claim that child. All right, so refresh from chapter 2. I mean, we've already talked about these. These go over the tiebreaker rules again, and here are several examples of that. And I would urge you to pause on this section and read through these to make sure that they make sense for you. However, these aren't something that we actually have to deal with. This is what the IRS uses for making these determinations, and it's something that we would have to keep in mind to know, if there is this circumstance, who would be able to claim the child and who shouldn't be claiming the child. And this goes into more examples here. Here is saying that a taxpayer cannot be a qualifying child, so that disqualifies them from the earned income credit. And this is just a continuation of that. And here we have an example. Okay, so single individuals can claim earned income credit. They don't have to have a child, but the credits are substantially lower, and they're very similar requirements. There is an age requirement, which is kind of interesting, that if you're too young, you can't apply for earned income credit, and if you're too old, you can apply for earned income credit. So that's kind of an interesting distinction. Okay, so here's an example. This goes over the age requirement. So you must be at least 25. You have to be under 65 by the end of the tax year to be able to claim the earned income credit. Okay. It talks about some of the more fine details of this, but you usually don't run into those things. And again, you can't be a dependent. That's similar to a lot of other credits. Here's an example of that. Might be a qualifying child. We already talked about that. You have to have lived in the U.S. for more than half of the year. Um, so, you know, that's pretty straightforward. Okay, this talks about due diligence as far as the earned income credit goes, and these are important things to keep in mind while doing the actual tax return itself. Okay, so these talk about a lot of the questions that we talked about in the last section about doing your due diligence, asking questions, making sure things make sense. Except these just apply more to the earned income credit than they do, the child tax credits. All right, and this is an example. This, also includes the 8867, but it just includes the example of that. And again, that form is completed automatically by Profiler in filing. I'm not going to spend much time on this. Here's another example. So asking questions about additional sources of income is somewhat important because you need to, if somebody has a substantially low income, I guess, it's you need to ask about that because let's say you've got an individual with 3 children and they brought in $6,000 total for the household for the year. You got to ask about that because how can they possibly support 3 children plus an adult on $6,000 of income? It's just not possible. I mean, there are resources that help. They might have food assistance, they might have rent assistance, that kind of stuff. But that's something you need to ask about and you need to make notes of because you just got to think about the fact that $6,000, it's $500 a month. Like rent is out of control these days. You know, rent is typically double that for a lot of people living in urban areas, and you just got to ask questions to make sure that things are making sense. Okay, so you don't have to necessarily quiz. Well, you don't have to, um, you know, go too deep into detail or make it seem like you're doing, you're not playing bad cop here and trying to force information out of them. Um, but you need to make sure that things are making sense. All right, so here's an illustration about that. This is talking about calculating earned income credit, but we don't really have to do that because the program does it for us, okay? So this is an illustration and completing 8867. Here are some of the common questions that you should ask when completing the due diligence requirements. Then this is the table that I left this in here because sometimes you do pull this out and look at where they're at for their earned income. So, like if someone has $30,450 earned income, or in between these two, it's $50 difference. Those are the amounts. If they're a single individual, they get no credit. One child, 2 children, 3 children. After three, there's no additional benefit, and there's a big jump, between 1 and 2. So um, they this is something you do look at every once in a while, even though the program does it for you. Okay. So this talks about their worksheet, which we don't actually fill out. This is how the worksheet is filled out. It goes back to the table, and then talks about the claiming earned income credit without a child and how that's done. And then claiming the EITC after disallowance. So this is very similar to in the previous chapter, the 8862, but that comes into play very infrequently. And reach out to anybody if you need help with that. Probably they're going to ask about what form is used after disallowance in the assessments. So here's another example and another. And then we get to our summary. So we've got talking about this is all about, earned income credit. It's a huge credit. Lots of people qualify for it. And there's just, some certain questions we have to ask to ensure that we're in compliance with all the rules that the IRS have for it. Okay, so I'm going to jump to the assessment portion here and go through a couple of those. Okay, so we just got in. I'm going to jump down to assessment and
click next to begin the graded assessment.
Go ahead and hit next. All right, so we're going to use our resources here, participants manual. All right, for a single taxpayer without a qualifying child, the earned income and AGI limit for claiming a federal earned income tax credit is, so single taxpayer with no children, got married filing jointly, that's for everyone. Okay, so here, rules if you don't have a qualifying child. Oh, okay, so single, that would be this one right here, if you don't have a qualifying child. So $15,820, which is not very much money, as everybody knows. That is the amount. That's the threshold. Okay, so then if a married filing jointly taxpayer have greater than blank in investment income, they do not qualify for earned income tax credit. Pretty sure that was 36.5, but let me just go here. Investment income limit, we are looking at $36,500. Okay. So this one only has 10, so you're actually 20% of the way there. I'm going to stop here and let you guys do the rest yourselves. But that gives you pretty much all the information you need for understanding these credits. They did change substantially. Substantially this year, and we need to make sure that that you learn those new dollar amounts, which we'll make sure that you do. But for the purposes of this assessment, you'll want to use the previous dollar amounts. All right, so I'm going to send this out to all of you guys. Thank you for your time this evening. Even if you reach out over the holiday in terms of Thanksgiving coming up, or if you listen to this down the road, don't ever reach out to, or don't ever hesitate. Don't ever hesitate to reach out to me for any reason that I can help you in tax school or with anything else. Just give me a call, shoot me a text, or send me an email, and I'll be happy to help. Thanks, guys. Bye.